Do you know that in the summer of 1998, a hedge fund operating out of Greenwich, Connecticut, came within 72 hours of triggering a chain reaction that would have collapsed major financial institutions across Europe, Japan, and the United States simultaneously? And that the people running it included two Nobel Prize-winning economists who had received their prize the previous year for the mathematical models they used to manage risk. The fund was called Long-Term Capital Management. It had been founded in 1994 by John Merriweather, a legendary bond trader from Salomon Brothers. Its partners included Myron Scholes and Robert C. Merton, the mathematicians who had, with Fisher Black, developed the Black-Scholes option pricing model, one of the most influential financial equations of the 20th century. It included David Mullins, the former vice chairman of the Federal Reserve. It included some of the most sophisticated quantitative traders in the world, men who had spent their careers building mathematical models of how financial markets behaved. Long-term capital management was, by any reasonable measure, the smartest money that had ever been assembled in one place. And in 90 days in 1998, it nearly destroyed the world. This is the story of what happened, and more importantly, why. Not just the sequence of events, but the intellectual architecture of the failure, the assumptions that were built into the models, the blind spots that those assumptions created, and the way that the most sophisticated thinking about financial risk that had ever existed turned out to be catastrophically wrong at precisely the moment it mattered most. John Merriweather had left Salomon Brothers in 1991 following a scandal involving a bond trading subordinate. A scandal that was not of his making, but that cost him his position and his reputation. He spent 2 years thinking about what he wanted to do next, and what he wanted to do was build the hedge fund that had been impossible at Salomon. A fund that would operate exactly according to the mathematical principles of arbitrage trading that he and his team had developed without the constraints and politics of a large investment bank. He recruited Scholes and Merton partly for their intellectual firepower and partly for their prestige. When Scholes and Merton joined Long-Term Capital Management, it sent a signal to the financial world that this was not an ordinary hedge fund. These were the men who had provided the mathematical foundation for modern options markets. If they believed in Merriweather's strategy, the strategy had to be taken seriously. The strategy itself was elegant, at least in conception. Long-term capital management would identify small pricing discrepancies between related securities, bonds, swaps, derivatives, and exploit them. These discrepancies were small, often fractions of a percent. But with enough leverage, enough borrowed money amplifying the size of the positions, small reliable spreads could be converted into spectacular returns. The specific trades LTCM made were numerous and complex, but the underlying logic was consistent. They would buy an asset that was cheap relative to a related asset and sell the related asset short. If the prices converged, as their models predicted they would, given the fundamental relationship between the two assets, they made money. If the prices diverged further, which their models said was very unlikely, they lost money. The models were built on decades of historical data. They were built on the assumption that the statistical properties of financial markets, the distribution of price changes, the correlations between different asset classes, the speed at which pricing discrepancies corrected, were stable and predictable. The history said these discrepancies always converge. The models quantified how likely that was, how long it would take, and how much leverage could safely be applied. LTCM's first 4 years were extraordinary. In 1994, its first year of operation, it returned about 20%. In 1995, 43%. In 1996, 41%. In 1997, 30%. These were not just high returns. They were high returns with apparently low volatility. The fund was doing exactly what it said it would, exploiting pricing discrepancies with precision, capturing reliable small spreads at enormous scale. By early 1998, Long-Term Capital Management had approximately $125 billion in assets. To put that in context, Many large national economies have GDP below that figure. The fund had about $5 billion of its own equity. The rest, roughly $120 billion, was borrowed. The leverage ratio was roughly 25 to 1. For every dollar the fund owned, it had borrowed 25 more. The derivative positions LTCM held were even larger than its balance sheet suggested. Derivatives are instruments whose value is derived from the value of an underlying asset. They do not require the full value of the underlying position to be held or borrowed. LTCM's total derivative exposure, its notional position in interest rate swaps, options, and other instruments, was approximately $1.2 trillion. $1.2 trillion. At a time when the entire US federal budget was about $1.7 trillion. None of the people who lent LTCM money fully knew the total exposure of the fund. LTCM was not required to disclose its full position to any single counterparty. Each bank that dealt with it knew its own exposure. None knew the aggregate. The fund had borrowed from and had derivative positions with every major financial institution in the world. Goldman Sachs, Merrill Lynch, Morgan Stanley, Deutsche Bank, Barclays, Credit Suisse, Societe Generale, UBS, Bankers Trust, Lehman Brothers, Bear Stearns, and dozens of others. The interconnection was total. If LTCM failed, every one of those institutions would take a loss. And because each institution was interconnected with the others, through their own lending and derivative positions, a failure at LTCM could trigger losses that cascaded through the entire system. The fund's vulnerability, though no one at LTCM fully believed it at the time, was that its models were built on an assumption that turned out to be wrong in a specific and devastating way. LTCM's models assumed that extreme market events, the kind of events that fell in the tail of the probability distribution far from the average, were rare and recoverable. The models calculated what is called value at risk, the maximum loss that the fund was likely to experience on any given day, with 99% confidence. If the VAR model said the fund could lose at most $100 million with 99% probability, then only one day in 100 would produce a loss larger than that. The model was correct for normal market conditions. It was catastrophically wrong for abnormal ones. The distribution of financial returns, the shape of the bell curve that describes how often various outcomes occur, has fatter tails than a normal distribution. This is the insight that Nassim Nicholas Taleb would later articulate in The Black Swan and Anti-Fragile, but it was known, at least in academic finance, in the 1990s. Extreme events happen more often than a normal distribution predicts. The tail of the financial return distribution is fatter than the models assumed. LTCM's risk models were built on historical data. But historical data from any finite period does not capture all possible extreme events. If the models were calibrated on 20 years of data, they could not contain the lessons of events that had not occurred in those 20 years, and the specific combination of events that would occur in 1998. Russia defaulting on its sovereign debt simultaneously with a global flight to safety that compressed liquidity across all markets simultaneously, had not occurred in any form that the historical data captured. The models said, these positions are safe because they have always corrected in the past. What the models could not say was, what if this time is different? What if the specific mechanism by which these positions correct, the existence of willing buyers and sellers in liquid markets, temporarily ceases to exist? The Russian default of August 17, 1998, was the event that changed everything. Russia had been struggling economically since the collapse of the Soviet Union in 1991. The transition to a market economy had been chaotic and catastrophic for ordinary Russians. GDP had fallen dramatically. Inflation had periodically been severe. The 1997 Asian financial crisis, the collapse of the Thai baht, followed by the spread of currency and financial crises through South Korea, Indonesia, and Malaysia, had further reduced global investor appetite for emerging market risk, including Russian risk. By the summer of 1998, Russia was running out of foreign currency reserves. The ruble was pegged to a band against the dollar, and defending that peg was draining reserves. The government was borrowing to finance its deficits at interest rates that reflected the market's growing concern about its ability to repay. On August 17, 1998, Russia announced that it was defaulting on its domestic debt, devaluing the ruble, and imposing a moratorium on repayment of certain foreign obligations. The immediate market reaction was severe. Russian bonds collapsed. But the secondary effect was the one that mattered for LTCM, a global flight to safety. Investors around the world, suddenly reminded of how quickly a government can default and a currency can collapse, moved their money out of anything that carried risk and into the safest possible assets, primarily United States Treasury bonds. This flight to safety compressed the spreads that LTCM had been exploiting. The pricing discrepancies between related securities, which LTCM's models said would narrow over time, instead widened dramatically. The cheap assets got cheaper. The expensive assets got more expensive. Instead of converging, the positions diverged. This is the failure mode that LTCM's models had not adequately accounted for. Not just that positions might temporarily move against the fund, but that the liquidity required to exit those positions, the ability to sell what you own and buy back what you have shorted, might simultaneously disappear across every market in which the fund operated. The scale of the losses in August and September 1998 was extraordinary. LTCM lost more than $1.8 billion in August alone. In the first 3 weeks of September, it lost another $1.5 billion. The fund, which had started 1998 with $5 billion in equity, was down to less than $600 million by September 22nd. The 25-to-1 leverage that had produced spectacular returns in normal times was now producing spectacular losses. For every dollar of equity that disappeared, $25 of borrowed money was at risk. The fund was approaching the point where it could not meet its margin calls, the demands from its lenders to post additional collateral against its borrowings. If LTCM could not meet its margin calls, its lenders would begin selling its positions. But the fund's positions were so large and so widespread across so many markets that forced selling at scale would push prices further against the remaining positions, triggering more margin calls, forcing more selling. The spiral was self-reinforcing. And because the positions were spread across every major financial institution on Earth, a cascade of forced selling by LTCM would produce losses at every bank and broker that had positions with it. In September 1998, the Federal Reserve Bank of New York conducted a rapid assessment of what would happen if LTCM failed. The losses at major financial institutions from the immediate impact of the default, combined with the market disruption caused by the forced selling, could destabilize several major institutions simultaneously. The word that the assessors used was systemic. The potential failure was not just LTCM, it was the system. William McDonough, the president of the Federal Reserve Bank of New York, made a decision that would be debated for decades. He would organize a private sector rescue. The Federal Reserve would not put government money into LTCM. That would be a bailout of a hedge fund, politically and institutionally unacceptable. But the Fed could bring LTCM's major creditors together, explain what they were facing collectively, and see whether a private rescue was possible. On September 23, 1998, representatives of 16 major financial institutions gathered at the Federal Reserve Bank of New York. McDonough laid out the situation. LTCM was on the verge of defaulting. If it did, the forced liquidation of its positions would produce market disruption and institutional losses that threatened to be severe. He asked whether the institutions were willing to collectively recapitalize the fund, take over its management, and wind down its positions in an orderly way. The institutions had every incentive to let the fund fail, except one. Each of them was exposed to LTCM, and each of them was exposed to the others. A disorderly failure of LTCM would hurt everyone in the room. The collective interest in preventing it was aligned, even if the individual interest of any one institution might be to let the others bear the cost. After hours of negotiation, the consortium agreed to inject $3.6 billion into LTCM in exchange for 90% of its equity. The existing partners, who had collectively lost almost all of their own investment, would retain 10%. The consortium would take over management and wind the positions down over the following months. The rescue worked. The market stabilized. LTCM's positions were unwound over the next year. By early 2000, the fund was dissolved. The crisis, at least in its acute phase, was over. But the questions it raised were not. The questions that long-term capital management raised have occupied financial economists, regulators, and risk managers for the decades since. The first and most fundamental question is about the nature of financial models. LTCM's models were the most sophisticated of their era. They were built by the people who had mathematically described how financial markets worked, and they failed catastrophically when it mattered most. The failure was not random bad luck. It was systematic. The models worked in normal conditions and failed in abnormal ones. The precise conditions in which robust risk management is most needed, crisis, panic, systemic stress, are the conditions in which the models are least reliable. This is not a problem specific to LTCM's models. It is a property of any model built on historical data. Historical data captures what has happened. It cannot capture what will happen for the first time. And in financial markets, first-time events, the crash of 1929, the oil shock of 1973, the Russian default of 1998, the subprime crisis of 2008, are the events that determine outcomes. The normal periods are periods of gradual accumulation. The crisis periods are periods when everything changes. The second question is about leverage. LTCM's leverage of 25 to 1 was not unusual in certain parts of the financial system in 1998. Investment banks operated at comparable or higher leverage. The logic of leverage is attractive. It amplifies returns. The logic of leverage in crisis is devastating. It amplifies losses at the same rate it amplified returns. The specific danger of leverage combined with model-based risk management is that the models create the illusion of safety. If the VAR model says the fund can lose at most $100 million with 99% confidence, and you have $5 billion of equity, the leverage seems manageable. What the model does not fully capture is the possibility that the 1 in 100 event is not $100 million, but $5 billion, a loss that wipes out the entire equity. The tails of the distribution are not just fatter than the model assumes. They are fatter in ways that can be existential. The third question is about the interconnection of the financial system. LTCM's relationships with 16 major financial institutions, and through those institutions, with the entire global financial system, meant that its failure was not a private event. It was a systemic event. The failure of a single fund could have produced consequences across the entire global financial system, not because the fund was too big in the sense of being an important participant in the real economy, but because of the web of derivative and lending relationships that connected it to every major financial institution on Earth. This was a new kind of risk. Traditional banking regulation was designed to prevent individual bank failures from spreading to other banks. But the LTCM crisis demonstrated a new mechanism of contagion. Through derivative exposures and the forced selling pressure that a large leveraged portfolio under stress could produce. The regulatory framework did not have adequate tools for assessing or managing this kind of systemic risk. The 2008 financial crisis, 10 years after LTCM, exhibited the same mechanism at far larger scale. The interconnection of major financial institutions through mortgage-backed securities, credit default swaps, and other derivatives meant that the failure of Lehman Brothers could threaten the entire system, just as the near failure of LTCM had done. The regulators who had seen LTCM had not built the tools to prevent the recurrence of the same dynamic. The Nobel Laureates fared differently after 1998. Robert Merton continued his academic work and remained a significant figure in financial economics. He has reflected, in the years since, on the LTCM experience as a lesson about the limitations of models applied to complex systems. Myron Scholes was more directly involved in the management of LTCM and took more direct reputational damage from the fund's failure. He continued to work in finance and academia. John Merriweather, the architect of the fund, was not finished. In 1999, he founded a new fund, JWM Associates, which operated for a decade before suffering heavy losses in the 2008 financial crisis and being wound down. He later founded a third fund, which also experienced significant losses. Merriweather's story is the story of a genuinely exceptional trader who operated at the limit of what financial markets could absorb, and who found, repeatedly, that the limit was not where the models said it was. The deeper irony of LTCM is that the mathematics were not wrong. The convergence trades that LTCM made did eventually converge. If the fund had had more equity, or less leverage, it could have survived the period of temporary divergence and recaptured its profits. The positions that the consortium bought at 40 cents on the dollar were worth par by the time they were unwound. The models had been correct about the fundamental relationships. They had been wrong about how much stress those relationships could sustain before the fund was forced to liquidate them. This is perhaps the most important lesson of the LTCM story. It is possible to be right about the fundamentals and still lose everything, if you are wrong about how long you can survive before the fundamentals reassert themselves. The markets can remain irrational longer than you can remain solvent, a truth attributed to Keynes that LTCM lived and nearly died by. Long-term capital management collapsed in 90 days. The Federal Reserve orchestrated a private sector rescue that prevented a systemic crisis. The fund was wound down. The regulatory discussions that followed produced some changes in how financial institutions reported and managed their exposure to hedge funds and derivatives, but not enough changes to prevent the same dynamic from reappearing at far larger scale in 2008. The story of LTCM is often told as a story about the hubris of genius, about mathematicians who believed so completely in their models that they forgot the models were simplifications of reality. This is a fair characterization, but an incomplete one. The people at LTCM were not fools. They were not reckless in any simple sense. They were the best practitioners of quantitative finance that existed. Their failure was not the failure of intelligence. It was the failure of a particular kind of confidence. The confidence that what had always been true in the past would remain true in the future, that the mechanisms of financial market equilibrium would continue to operate in the specific form the models described, even under conditions of systemic stress that had no historical precedent in the data. That confidence was wrong, and it turned out to cost not just the partners of long-term capital management their wealth, but the rest of the world its stability. For the 3 weeks in September 1998, when the financial system of the planet was closer to collapse than almost anyone outside the Federal Reserve Bank of New York knew. This is long-term capital management, the smartest hedge fund in history, and how it nearly ended the world.